Most people think the rich have some secret tax loophole that allows them to pay nothing. Others believe there's a hidden strategy the government doesn't want you to know about. And every year, millions of Americans end up paying more taxes than they legally owe because they never learn the rules. Now, before we begin, let's get one thing straight. There is no magic trick. There is no secret button that makes your taxes disappear overnight. And unless you're a billionaire with an army of tax attorneys and complex offshore structures, you're probably not getting your tax bill down to zero. But that doesn't mean you can't save thousands of dollars legally. In fact, most people overlook dozens of perfectly legal tax saving opportunities every year, and those small savings add up. Today, we're going to break down some of the most effective and completely legal ways to reduce your taxes in the United States. If you're earning under $400,000 a year, this video is especially for you. Let's get started. The first strategy is taking advantage of commuter benefits. If your employer offers a commuter benefit program, don't ignore it. Many workers can pay for commuting expenses using pre-tax dollars. This can include public transportation, parking fees, parking garages, ride-sharing services, and other eligible commuting expenses. It may not sound exciting, but reducing your taxable income month after month can save real money over the course of a year. Next, let's talk about one of the biggest tax-saving tools available to everyday Americans: retirement accounts. If your employer offers a 401k or a 403b, you should seriously consider using it. Every dollar you contribute lowers your taxable income today while helping you build wealth for the future. It's one of the rare situations where you can potentially pay less in taxes and invest in yourself at the same time. Many people focus only on the tax refund they might receive. Smart investors focus on reducing taxable income before the IRS ever calculates the bill. Another powerful strategy is using a health savings account, also known as an HSA. If you have a qualifying high-deductible health plan, an HSA can be one of the most tax-efficient accounts available. You contribute pre-tax money. The money can grow through investments, and when used for qualified medical expenses, withdrawals can be tax-free. That's a rare triple tax advantage. You save on taxes when you contribute. You save on taxes while it grows, and you save on taxes when you spend it on eligible healthcare expenses. Not many accounts can do that. Another option is the flexible spending account, or FSA. Like an HSA, it allows you to use pre-tax dollars for certain healthcare expenses. But there's an important catch. Many FSAs follow a use it or lose it rule. If you don't spend the money by the end of the year, you may lose it. So while an FSA can be valuable, make sure you understand your employer's specific rules before contributing. If you have children or dependents, don't overlook the Dependent Care FSA. This account allows you to use pre-tax dollars to pay for qualified care expenses. That can include daycare, preschool, after-school programs, babysitters, adult daycare facilities, and other eligible services. For families already paying these expenses, this can create meaningful tax savings. Now let's move into investing. One of the most overlooked tax-saving opportunities comes from losses. Nobody likes losing money on investments, but if you do have losses, make sure they're properly reported. Investment losses can offset gains and reduce taxes. This is especially important for cryptocurrency investors. Many people carefully track their stock trades, but forget about crypto transactions. And when they fail to report those losses, they miss valuable deductions that could lower their tax bill. Speaking of investments, holding assets for the long term can significantly reduce taxes. When you hold investments for more than 1 year before selling, they generally qualify for long-term capital gains treatment. Long-term capital gains are often taxed at lower rates than ordinary income. For some taxpayers, the federal tax rate on those gains may even be zero. That's one reason long-term investors often have a major advantage over frequent traders. Another important step is reviewing your tax documents carefully. Every year, brokerage firms send investors forms reporting their gains and losses. Don't assume those forms are perfect. Mistakes happen. One of the most costly errors occurs when the purchase price of an investment is missing. If that information isn't reported correctly, it can appear as though your entire sale amount was profit. That can lead to a much larger tax bill than you actually owe. A few minutes of review could save you hundreds or even thousands of dollars. If you invest using margin, there's another deduction many people miss: margin interest. Many investors pay interest on borrowed funds but forget to include that expense when filing taxes. Review your investment records carefully. That deduction is often overlooked. Now let's talk about something completely different: gambling. If you've ever won money at a casino, sportsbook, horse track, or other gambling venue, you may receive tax forms reporting your winnings. What many people don't realize is that gambling losses may be used to offset gambling winnings under certain circumstances. That doesn't mean gambling becomes profitable, but it does mean accurate record keeping can prevent you from paying more taxes than necessary. Another strategy worth considering is a traditional IRA. Unlike employer-sponsored retirement plans, a traditional IRA is something you can establish on your own. Depending on your income and circumstances, contributions may qualify for a tax deduction. That means another opportunity to reduce taxable income while saving for retirement. If education savings are part of your financial plan, you should also explore a 529 plan. While contributions may not reduce your federal taxes, some states provide tax benefits for contributing. Even when no state deduction is available, earnings can grow tax-free when used for qualified education expenses. Over time, that tax-free growth can make a substantial difference. Here's another area many people overlook: their paycheck, specifically their W-4. If you consistently owe money to the IRS every year, you may be under withholding taxes throughout the year. In some cases, that can lead to penalties in addition to the taxes you already owe. Adjusting your W-4 can help prevent surprises and keep your tax situation on track. Finally, let's talk about a little-known rule that applies to homeowners. If you rent out your home for a very limited period during the year, you may qualify for a special tax benefit. Under what's often called the minimal rental use rule, qualifying rental income may be tax-free if specific requirements are met. Many homeowners don't even realize this rule exists. And because they don't understand it, they may end up reporting income incorrectly or paying more tax than necessary. The truth is that reducing your taxes legally isn't about finding one giant loophole. It's about understanding the rules, using the accounts available to you, taking the deductions you're entitled to, and avoiding the mistakes that cause millions of people to overpay every year. The wealthy don't always pay less because they know secrets. Many simply know the tax code better. And the more you understand how the system works, the more opportunities you'll find to keep your hard-earned money working for you instead of unnecessarily sending it away. If you found this video helpful, make sure to hit the like button and subscribe to the channel. And let us know in the comments which of these tax-saving strategies surprised you the most. Thanks for watching. See you in the next one.